Well, usually when we talk about a medical diagnosis, there is a strict expectation of precision. Like if you fall off a ladder and break your arm, the X-ray shows a very jagged white line across the bone.
Right, the data is totally unambiguous.
Exactly. The doctor points to it, gives you a definitive answer, and well, we naturally crave that kind of visible, perfectly categorized certainty in almost every aspect of life.
Oh, absolutely. I mean, it provides comfort, right? A broken bone is just a binary state. The treatment plan is immediately obvious because, there's no guessing involved.
But when you step into the world of macroeconomics and uh, try to diagnose the health of the entire global economy or even try to predict a recession, suddenly that X-ray machine is just completely malfunctioning.
Yeah, it's the absolute definition of diagnostic muddy waters. You have these conflicting signals everywhere you look.
Right, because everyone from Wall Street analysts to, everyday retail investors, they're all staring at the exact same economic data. Yet half the room is diagnosing a terminal illness and the other half is like prescribing a victory lap.
Exactly. I mean, unemployment might tick down while consumer debt picks up, or a tech sector might be booming while manufacturing contracts. Sifting the signal from the noise requires looking past the surface level panic and really diving straight into the underlying mechanics of how these companies are actually operating.
And that is exactly what we are going to untangle today. So welcome to another deep dive. We are thrilled you're here with us. Today's mission is to basically bypass the pundits and look at the hard data.
Yeah, we are combing through a massive batch of recent earnings reports from over 100 companies across multiple industries.
Right, to figure out if a recession is actually on the horizon or if the global economy is just, fundamentally rewiring itself. Now, to help navigate all of this complex data before jumping into the analysis, I have a quick message for you. To access more advanced researches, applications, and our latest published personal intelligent multi-agent deep value intelligence, welcome to explore and join the deepvalues.ai community. To track total market temperature, welcome to search and download the iOS app Buffett Indicator from the Apple App Store.
And, as always, we need to set the ground rules before we begin. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel are for educational and research purposes only and do not constitute investment advice. Conduct your own due diligence before making investment decisions. If you'd like to access wider topics, including life and investing philosophy, please subscribe to our sister channel, Deep Values. Don't forget to like this video. Much appreciated.
Awesome. So is a recession actually on the horizon, or are the doomsayers just getting it wrong again? Let's start with the heavy macro clouds hanging over the entire market right now.
Yeah, before we can even look at individual companies like Tesla or Boeing, we really have to address those macro fears.
Right. I mean, we currently have this completely opaque, ongoing conflict in Iran. Contradictory statements are coming out daily, and geopolitical tension is incredibly high, and yet the market mostly just shrugs it off.
It's wild. It keeps rallying, seemingly operating under this assumption that the conflict will be resolved swiftly.
Which is a highly optimistic baseline.
Yeah.
But the domestic economic warnings are honestly arguably louder right now.
Oh, absolutely. I mean, you have heavy hitters like former Treasury Secretary Hank Paulson issuing these dire warnings.
Yeah, he recently suggested we could see a, quote, potential collapse in the treasury market because the U.S. debt to GDP ratio has hit an all-time high of 125%.
Right. And when a former Treasury Secretary says the sky is falling, people naturally panic. It feeds into this massive psychological loop.
Okay, let's unpack this, because pushing back against the doom-mongering is important here. Predicting a crisis is a lot like predicting a massive blizzard.
How do you mean?
Well, if you go on TV and say a massive blizzard is coming every single day for 40 years, eventually you'll be right. But that's to make you a good meteorologist.
That's a great analogy.
Right. And looking at Paulson specifically, his track record isn't exactly flawless. Back in August 2007, right before the entire global banking system nearly evaporated, he famously stated that the subprime mortgage fallout was, quote, largely contained.
Wow. Yeah, that historical context is crucial when you're evaluating these massive doomsday declarations. Because if we look at the actual structural mechanics of Paulson's debt warning, there are two massive counterarguments.
What's the first one?
First, we have an international precedent. Japan currently operates with a debt to GDP ratio of 240%.
Wait, 240? That's almost double the United States ratio.
Exactly. And while Japan has definitely faced economic stagnation, their sovereign debt markets function perfectly well. They haven't experienced the catastrophic implosion Paulson is warning about for the U.S.
That's a really good point. And the second counterargument involves the actual plumbing of the global financial system, right? Specifically, the multi-trillion-dollar repo market.
Right. So the repo market or repurchase agreement market is essentially where the world's largest banks and institutions park their cash overnight.
Because when an entity has billions of dollars that need to be secured for a short period, they can't simply put it in a traditional savings account.
Exactly. They need an incredibly safe, highly liquid asset to hold as collateral. And the entire global financial system basically requires short-term U.S. treasuries to function as that collateral.
Yeah, because there is literally no other asset on planet Earth large enough or liquid enough to absorb that much capital. I mean, if you're managing a $1 trillion pension fund, you have to buy U.S. treasuries. It's not a choice.
It's a structural requirement. Which brings us to the ultimate metric of market fear, which is the 10-year treasury yield.
Right. If institutional investors were truly panicked about the U.S. government defaulting, the perceived risk of holding that debt would just skyrocket.
Yep. And to compensate for that massive risk, buyers would demand much higher interest rates. But the 10-year yield has been sitting relatively stable in the 3.9 to 4.5% range.
That metric alone tells us institutional panic simply isn't materializing in the actual data, so the macro sky remains firmly in place.
Which provides a great foundation to look at the actual companies operating underneath it.
Yeah. And when you look at the 100-plus earnings reports we reviewed, the most fascinating realization is that the massive growth driving the economy isn't happening where the mainstream media claims it is.
No, not at all. The prevailing narrative treats the whole artificial intelligence boom as this ethereal, software-only, cloud-based phenomenon.
But the actual revenue explosion is happening in heavy physical industry.
Right. It's the physical backbone of the AI revolution. I mean, you cannot run a digital revolution without pouring concrete and forging steel.
Exactly. Look at the aerospace sector. Despite those geopolitical war fears and the threat of high oil prices, GE Aerospace just reported their total orders rose by a staggering 87%.
Wow.
Yeah, hitting $23 billion. And Boeing, a company that has experienced years of highly publicized catastrophic manufacturing issues, they managed to deliver 143 commercial planes in the first quarter.
Which is what, their best delivery number since 2019?
Yep, accompanied by significantly lower than expected cash outflows.
So the demand for physical transportation and infrastructure is just completely overwhelming the negative sentiment. But the most striking example of this physical boom is GE Vernova, or GEV.
Right. They manufacture those massive gas turbines used by utility companies, along with critical electrification equipment.
Yeah, and their growth narrative really requires understanding the sheer scale of the United States electrical grid. Prior to 2020, electrical production in the U.S. was functionally flat.
Because the country wasn't really building massive new factories and, household appliances were getting more energy efficient.
Exactly. But today, U.S. electrical production is growing at about 3% annually.
Which, and let's clarify this, 3% might sound like a rounding error in the tech world.
Right, 3% sounds tiny.
But applied to the baseline of the entire American electrical grid, it represents a staggering, earth-shifting amount of new electricity required every single year.
It's massive. And this demand is basically driven by two things. First, a broad push to reindustrialize American manufacturing. And second, the insatiable power demands of AI data centers.
Yeah, training a large language model requires massive server farms that just consume enormous amounts of electricity purely to keep the computer chips from melting down.
And that electricity has to come from somewhere. It requires new power plants, and those plants require gas turbines.
And the global manufacturing capacity for those turbines is basically an oligopoly, right? It's controlled by three companies: GE Vernova, Siemens, and Mitsubishi.
Yep. Which explains why GEV saw their orders rise 71% year over year to $18.3 billion.
Okay, here's where it gets really interesting, though. Let me play devil's advocate for a second. If GEV is trading at a massive 2026 price-to-earnings ratio of 80 times mom, isn't that just a dangerous hype bubble?
Well, if GEV were a consumer software application, an 80x PE ratio would absolutely signal a bubble. But evaluating heavy industry requires a totally different timeline.
Because it's a long-tail business.
Exactly. It takes years to physically forge, manufacture, transport, and install a commercial gas turbine. When GEV secures an $18 billion order today, they cannot instantly record that as revenue.
Right. The market is pricing in the guaranteed multi-year pipeline of contracted work.
Yeah, so if you extend your timeline out to 2028 as that revenue is actually realized, their PE ratio drops to a much more reasonable 36x. It's a story of guaranteed future visibility.
And that visibility stands in brutal contrast to the software companies actually building the AI tech.
Oh, completely. The software sector is facing immense pressure right now.
Yeah, the margin for error from Wall Street has effectively dropped to zero. The earnings reports from legacy and cloud software providers reveal an incredibly precarious narrative.
Take ServiceNow as a prime example of this. They just beat expectations by posting massive 22% revenue growth.
And usually, Wall Street rewards that kind of performance handsomely.
Right. But during their earnings call, leadership mentioned a minor delay in closing some deals in the Middle East due to the ongoing geopolitical conflict.
And the stock immediately plummeted 13% after hours, just from a minor delay.
Exactly. Then you have IBM, a bedrock tech company, falling 7% simply because their software revenue is categorized as in line with expectations.
Merely meeting the target is suddenly being punished as a failure.
It's brutal. But then, on the other hand, there's the psychological anomaly of Tesla.
Oh, Tesla. It's described as a dream stock, where bulls and bears argue about two completely different companies.
Yeah, it operates like a Rorschach test for investors. The bears look at the financials and see a car company with shrinking margins and missed revenue targets.
But then Elon Musk gets on the earnings call and announces he is increasing capital expenditure on AI and robotics to over $25 billion.
Right, and the bulls immediately disregard the auto sales. They just value the company as a utopian robotics firm, somehow maintaining a 2026 PE ratio of over 200x.
They are essentially analyzing two different companies sharing the same ticker symbol.
Very true. But beyond the individual stock volatility, there is a fundamental shift happening underneath the entire software industry.
Yeah, one of our sources featuring notes from a tech insider highlights how AI is actively disrupting the core business model of software as a service, or SaaS.
Yeah, for the last decade, the primary revenue model for business-to-business software was simple. You sell licenses, or seats, per employee.
Right, a company hires 100 customer service reps, they buy 100 software licenses, you grow revenue by adding more seats and periodically raising the price of each seat.
But AI completely fractures that equation. The whole mechanism of AI automation means a single intelligent agent can potentially handle the coding, data entry, or customer service volume of 10 human employees.
If a company implements that AI, they no longer need to hire those 10 humans.
Exactly, which means they do not need to purchase those 10 software seats. The era of blind pricing power and infinite seat expansion in B2B software is coming to an abrupt end.
And the dynamic isn't much better in the business-to-consumer space either. Generative AI has made writing code and building basic consumer software incredibly cheap and accessible.
The barrier to entry has practically vanished.
But getting people to actually find and use your app, the user acquisition and distribution, remains incredibly difficult.
So all that venture capital money funding thousands of new consumer AI apps is essentially just being funneled straight into the advertising networks of Google and Meta.
Just to acquire users. The technological moat is no longer the software code itself. The moat has become the distribution network.
Which brings up a major accounting issue that completely changes how we view tech earnings. Stock-based compensation, or SBC.
Oh, I have strong feelings about this. For years, tech bulls have argued that paying employees in stock options shouldn't be heavily scrutinized because it isn't, cash out the door.
Which is a very convenient narrative for them.
I find that logic entirely absurd. It's like having a broken pipe in your house and paying the plumber by giving him a percentage of your property deed and then bragging to your friends that you got the plumbing fixed for free.
That's hilarious, but it's so accurate.
You didn't get it for free. You diluted your ownership. Dilution is a massive, tangible risk to retail shareholders.
Yeah.
What does this mean for the future of the industry?
Well, this is exactly why generally accepted accounting principles, or GAAP, requires stock-based compensation to be recorded as a real expense on the income statement.
Right?
GAAP rules are designed to reflect the true economic reality of a business. When a company issues new shares to employees, the existing shareholders own a smaller percentage of the future profits.
It represents a real transfer of wealth. Tech companies can no longer hide behind non-GAAP adjusted earnings to mask their true operating costs.
No, they can't. But, this structural rewiring isn't just happening in corporate software or massive power grids.
Right. The deep dive moves from the tech elite to the foundational elements of the everyday consumer economy.
Exactly. How we pay for doctors, how we buy houses, and how we borrow money. The healthcare sector earnings perfectly illustrate this shift.
Let's get into that. United Healthcare, or UNH, managed to beat earnings expectations because of an improving medical loss ratio.
Let's define that metric for a second, because it really is the lifeblood of health insurance.
Good idea. So the medical loss ratio, or MLR, is a percentage of premium dollars an insurance company spends on actual medical claims versus administrative costs and profits.
Right. So if an insurer collects a dollar in premiums and spends 85 cents on medical care, their MLR is 85%.
And a lower ratio means higher profits. UNH is successfully lowering theirs by repricing their premiums.
However, UNH's Medical Services Division, Optum, presents a massive long-term regulatory risk due to their aggressive coding practices.
And just to be absolutely clear here, because we were just discussing AI software coding, when we say aggressive coding in healthcare, we mean medical billing codes.
Yes, very important distinction. We are talking about the diagnostic codes doctors and administrators submit to Medicare and insurance providers for reimbursement.
Precisely. And Optum has been incredibly aggressive in finding and submitting codes to maximize their Medicare Advantage payouts.
But as the government changes the pricing systems to penalize that kind of aggressive billing optimization, Optum faces a significant structural headwind.
We see another massive headwind in the earnings of Molina Healthcare. They technically beat earnings, but their underlying data flashed a major warning regarding Medicaid attrition.
Yeah, this is a big deal. During the pandemic, emergency rules prevented states from removing people from Medicaid rolls. Enrollment just exploded.
Yeah, that process is unwinding, and states are auditing their lists.
Right. And the mechanism of this attrition creates a severe problem called adverse selection.
Meaning what, exactly?
Well, as the government prunes the Medicaid rolls, the people losing coverage are generally the healthier individuals who have found employment or alternative insurance.
So the people who remain eligible and stay on Molina's plans are statistically a much sicker cohort with chronic needs.
Exactly. And a sicker patient pool requires far more medical care, which will inevitably drive up Molina's medical loss ratio and threaten their future profitability.
It's fascinating how a seemingly positive macro trend, like people finding jobs and leaving Medicaid, creates a localized crisis for a specific healthcare company.
It really is. And speaking of localized phenomena completely defying the macro trends, we have to look at the housing market.
Oh man, the housing market.
Mm-hmm.
Mortgage rates connected to that 10-year yield crept up to 4.4%, heavily battering the traditional spring selling season. Traditional logic suggests home builders should be in an absolute freefall right now.
Yet companies like DHI, Meritage, and Pulte are surviving and in some cases truly thriving.
They are surviving purely because of financial engineering.
Yes, the buy-downs.
Right. These massive home builders have accumulated significant profit margins over the last few years. They use those profits to pay the banks upfront to temporarily lower or buy down the mortgage interest rate for their buyers.
It's a brilliant mechanism. It keeps the monthly payment affordable for the consumer while allowing the builder to maintain their sales volume despite the high macro interest rates.
And Meritage Homes demonstrates just how confident these builders are in their own financial positions. They recently bought back 3% of their outstanding shares because the stock was trading below its $75 tangible book value.
Which is an incredible signal.
Yeah, let me explain that, because tangible book value is the ultimate worst-case scenario metric. It means if Meritage stopped operating tomorrow, sold off every piece of land, lumber, and heavy machinery they owned, and paid off all their debts, they would have $75 per share in pure physical asset value.
So by buying back their stock below that price, they're essentially acquiring dollar bills for 90 cents.
Exactly. The underlying consumer economy is demonstrating an incredible stubbornness, just refusing to slip into the recession the pundits keep predicting.
But while the physical consumer economy holds strong, the old guard of financial gatekeeping is really beginning to crack under the pressure.
Yeah, the invisible credit systems that power everything. The easy money era is ending for massive institutions.
Look at Blackstone. Their $81 billion private credit fund, BCRD, reported flat performance driven entirely by write-downs on loans they made to companies like Medallia and Affordable Care.
Private credit was the gold rush of the last 5 years, and now the mine is starting to collapse. But honestly, the biggest earthquake in the financial sector has to be the end of the FICO monopoly.
Oh, this is huge. Fair Isaac, the company behind the FICO score, has operated as an invisible gatekeeper for decades.
Literally every single time an American applies for a conventional mortgage, the lender is required to pull a FICO score.
It has been an absolute federally mandated monopoly. But the Federal Housing Finance Agency, the FHFA, which regulates Fannie Mae and Freddie Mac, just announced a monumental policy shift.
Right. They will now allow lenders to accept Vantage Score models as a direct alternative to FICO. So what does this all mean? Imagine an invisible gatekeeper that has controlled American mortgages for decades suddenly getting real competition.
It changes everything because the mechanism behind VantageScore is entirely different. Traditional FICO scores largely ignore individuals who don't utilize traditional credit cards or auto loans.
Which leaves millions of people out in the cold.
Exactly. VantageScore incorporates alternative data, analyzing things like consistent rent payments, utility bills, and cell phone plans.
Which opens up the mortgage market to millions of credit-invisible Americans. By allowing this alternative, the FHFA leveled the playing field overnight.
And the market reaction was violent. FICO's stock plummeted over 40% this year, simply because a regulator allowed competition into their walled garden.
Over 40%. That is unbelievable.
Yeah. And if we zoom out and synthesize all of this data, from the dismantling of the FICO monopoly and Blackstone's credit struggles, to the complex survival mechanics of home builders, the shifting risk pools in healthcare, and the massive industrial boom required to power the AI revolution, we are clearly not looking at an economy in collapse.
No, we're looking at an economy that is fundamentally rewiring itself.
Absolutely.
I mean, to recap, heavy industry is experiencing a total renaissance just to feed the immense physical demands of data centers. Legacy software companies are losing their pricing power as AI automation reduces the need for human software seats, and decades-old credit monopolies are finally breaking open.
It is a profound transition period, and looking at the software data specifically, it leaves us with an incredibly provocative thought to ponder regarding the future of the tech industry.
Well, lay it on me.
If AI coding tools continue to make software development drastically cheaper, it vastly reduces the need for massive, expensive R&D and engineering teams, right?
Right, because the AI is doing the heavy lifting.
But the cost of sales, marketing, and user acquisition remains exactly the same.
Because distribution is still hard.
Precisely. So will the tech giants of tomorrow look less like brilliant engineering powerhouses and much more like traditional cutthroat marketing and distribution firms?
Wow. If the code itself becomes a cheap commodity, the only thing that actually matters is who controls the distribution pipeline. That is a truly wild thought to chew on.
It really reframes how you look at the entire sector.
It does. So whether you are trying to predict the next macro recession or just trying to figure out where the global economy is actually growing, remember? Yeah. Look at the hard data, study the underlying mechanisms, and ignore the people shouting from the roof. Thank you so much for joining us on this deep dive. Keep exploring, keep questioning the narrative, and we will see you next time.